Good afternoon. My name is Sonora Monks, ESA's Director of Programs and Education. Thank you for attending today's webinar titled U.S. Energy Storage Monitor First Quarter Summary. Today's webinar is being recorded and will be available at www.energystorage.org. Participant lines will be muted throughout the webinar. However, we welcome your questions and comments, which can be submitted at any time via the chat box on the left side of your screen. Following the webinar, you will receive a link to the recording and slides, as well as a brief survey regarding today's topics and topics for future webinars. Your feedback will ensure that ESA continues to provide the highest value information to you and your company. Today's speakers are Brett Simon, Energy Storage Analyst at GTM Research, and Dan Finfoley, Senior Analyst at GTM Research. And without further ado, I'll turn it over to Brett to begin today's presentation. Brett?
Great. Thanks, Sonora. That was an excellent introduction. Hello, everyone, and thank you for joining us for this webinar. Really appreciate you all being here, especially at this timely point, given that the 2017 Year in Review Energy Storage Monitor was just released yesterday. So we've got some really exciting points to cover on the U.S. market. So without further ado, just to quickly outline where we're going to go, we're going to open up talking about some different historical deployment trends we've seen in the U.S. market over the past few years. We're going to then move into some of the market drivers that have caused this market to shift and change. And then lastly, we'll end with our outlook, talking about where we expect this market to go over the next 5 years through 2023. So kicking off with deployment trends, the really important thing to note here also before I begin is that when we're tracking deployments, we're tracking them in both megawatts and megawatt hour terms, given that both metrics are important for any time you're talking about the energy storage market, both the power as well as the energy rating of energy storage deployed. So this slide here is looking at the megawatt rating. And quarter over quarter, the U.S. market grew 46%, growing from 42.5 megawatts in Q3 2017 up to 62 megawatts in Q4 2017. Year over year, the market declined 56%, but this is a bit misleading if you don't look at the historical trend, given that there was a massive spike in Q4 2016, which was the result of the Aliso Canyon projects coming online. For those who may not be aware, just a quick point on that, there was a natural gas leak discovered at the Aliso Canyon facility in late 2015, so it was mandated that there would be energy storage procured by local utilities in California to help meet capacity shortfalls the following year. So as a result, there was over 100 megawatts of energy storage permitted and installed in less than a 9-month basis, the majority of which came online in Q4 2016, with some of that also coming online at the beginning of Q1 2017. Something else important to note about Q4 2017 is it was a record quarter for behind-the-meter deployments. And when I'm saying behind-the-meter, I'm referring to both residential as well as non-residential, which includes commercial, industrial, municipal, religious type of buildings as well. Overall, the behind-the-meter deployments accounted for 55% of total megawatts deployed in Q4 2017, which is up from last quarter's share of about 27%. And this was from growth in multiple state markets, mainly led by California, but some other states were key as well, which I'll get into a little bit in a couple of minutes. Looking at the megawatt hour numbers here as well, here the story also continues to be interesting. The market grew 126% quarter over quarter from 24.9 megawatt hours in Q3 2017 up to 77 megawatt hours in Q4 2017. And quite a bit came from the behind-the-meter non-residential market, which saw a quadrupling in megawatt hour terms. And again, here we saw a year-over-year decline, 57%, again, from those Aliso Canyon projects, most of which were 4-hour discharge duration, meaning that they had quite a bit of megawatt hour capacity, a ratio of 4 megawatt hours for every 1 megawatt that they had, given that these are resources fulfilling capacity services in California. If we look at megawatt hours as well, the story gets even more exciting for behind-the-meter deployments, which made up 77% in megawatt hour terms, which this is the highest share. This is the highest absolute megawatt hours of behind-the-meter deployment in any quarter in the U.S. since GTM has started tracking the market. It's not the most in percentile terms, but nevertheless is exciting that over 3/4 of the market in megawatt-hour terms did come from these behind-the-meter systems. Of course, I hinted a little bit a minute or so ago about the different markets where we're actually seeing this growth. So it's important to break this out and go a little deeper, talking about where are we seeing the growth and why. When it comes to the behind-the-meter market, California is the undisputed champion. Much of that comes from the self-generation incentive program, which has provided a big boost to the market. In particular, the latest iteration of the program, which opened in May of 2017, had a residential carve-out, which has been integral in helping scale that market. Additionally, California is a market where we've seen a number of procurement programs which have involved behind-the-meter storage, both residential and non-residential. Most of those systems under those procurement programs have not come online yet, but we have started to see some trickle in here and there. And furthermore, on the residential side, there's been some interest in getting storage for residential customers to deal with time of use rates. The secondary category, or the markets that are in second place behind the meter, are what we term the all others markets, or the other markets. Currently, GTM Research breaks out our market coverage into 8 individual markets: Arizona, California, Hawaii, Massachusetts, New Jersey, New York, PJM, excluding New Jersey, and Texas. And we are planning to add more markets in the not-too-distant future. So these all other markets is basically a catch-all for every one of those non-8, the other 42, as it were, with also some coverage of DC and a few island markets as well that are controlled by the U.S. But individually, each of those markets is quite small, but collectively they make up a significant portion of overall deployments. In particular, I'll highlight on the residential side that we are hearing increasingly from solar installers and developers that they're seeing demand for residential storage for backup power in markets like the southeastern U.S. or the northeastern U.S., where there are concerns in the wake of natural disasters that folks want to have backup power. So, places like Florida, Georgia, and so on. In third place for residential is Hawaii. Hawaii is quite a ripe market for behind-the-meter residential storage, given some of the new solar programs that have been implemented, which limits or prevents, rather, the export of excess solar generation for new customers under the Customer Self-Supply program. There was previously a program, the Customer Grid Supply, which could allow compensation for solar export, but that program is now closed. So new solar customers in Hawaii have the choice of either undersizing their solar system or getting some form of storage to ensure that any excess solar generation is stored. And that's led to some pretty attractive economics in the Hawaiian market as well. It's one of the leading markets as well that market players are identifying as seeing demand for residential storage. In terms of non-residential, New York comes in third. New York is a market that's been slower to take off given some challenges around permitting lithium-ion systems, but nevertheless has seen deployments under programs like the Brooklyn-Queens Demand Management Program, and also some other deployments outside of New York City here and there where there have been some interest in offsetting demand charges among C&I customers. To go to the front of the meter side, the leader for 2017 was Texas. Most of those deployments were high-power, low-energy deployments for frequency regulation applications. California came in second. Again, here much of that was for capacity deployments. Some of that at the beginning of the year being that spillover from Aliso Canyon from the end of the year. And then in third, we had Arizona. Arizona is definitely a market to watch and that we've been keeping a close eye on, given that I'm sure some of you have seen in the news some of the exciting low bids that have come in for Arizona solar plus storage PPAs, which are quite interesting and are a good portent of where the storage market is going. That essentially dispatchable renewables, front of the meter solar plus storage is starting to become ever more competitive with traditional centralized generation. When it comes to technology, when it comes to energy storage, it's not enough just to talk about deployments, but it's also important to identify technology as well. And when we're talking about the market, we're certain to also take into account what technologies of storage systems are being deployed. And lithium-ion is far and away the market leader. It's had over a 94% share of the market for 13 quarters in a row. So, essentially, of three years of dominance by lithium-ion. And a big reason for that is that lithium-ion systems have seen massive cost declines over the last few years, really substantial reductions. And that's kind of created this almost virtuous cycle whereby, as lithium-ion systems get cheaper, more folks are employing them, so then more projects are getting deployed with lithium-ion. So financiers become more comfortable backing projects with lithium-ion because there is this existing operational data. In second place, we have lead acid, which still makes up an interesting portion of the backup power market for residential applications. I'll note that the storage that we're tracking in this report is all grid interactive, so we're not including off-grid or purely UPS applications, which is still a pretty important market for lead acid as well. And then finally, for the most recent quarter, Q4 2017, vanadium redox flow had a 0.2% share overall. And one of the challenges for emerging technologies like flow goes back to a point I made not too long ago, that there's this challenge in getting backing from financiers who haven't seen commercial applications of some of these emerging technologies. So while there are a handful of projects using vanadium flow batteries or zinc flow batteries, they're still few and far between in a market that's already pretty small, which has led to hesitance from market players to back and push forward those types of projects. However, as there's more demand for long duration storage, flow battery vendors are increasingly discussing the advantages they claim their projects have compared to lithium-ion, which has a more of a sweet spot in the 2 to 4 hour range. Corporate investments is another area that GTM research tracks closely, along with M&A. And in 2017, corporate investments in storage reached $1.4 billion. 63% of this total came from VC investments, and this amounts overall to a 20% growth from 2016, when roughly $1.1 billion was invested. Something that's notable, though, is 2017 saw a 37% drop in project financing, though VC investment more than doubled year over year. The biggest VC deal in 2017 was $400 million invested in a company called Microvast by CITIC Securities, and the largest project financing deal in 2017 was a $250 million financing facility to support solar plus storage. So really, there's been some quite interesting activity, and it's not pictured in this chart, but 2017 was also host to a variety of M&A activity where we saw companies like Enel, which acquired Demand Energy, or Wärtsilä, which acquired Greensmith, large multinational energy developers and energy companies getting into the storage market by acquiring U.S.-based storage companies to give them an arm to get into the market. And interestingly as well, with this M&A activity, a key theme across all of these mergers and acquisitions was that these storage companies had a strong software focus. A question we're constantly discussing and wrestling with here at GTM is, what do these systems actually cost? And it's a valid concern when thinking about this market, given that expense has been a concern in this market, and though we've seen substantial cost declines, it's nevertheless something that must be considered when thinking about storage versus other incumbent resources. When it comes to front-of-the-meter system prices, we've seen a decline of 3 to 9% year over year. Currently, what you can see on the screen is 2-hour and 30-minute prices for front-of-the-meter systems listed in dollars per kilowatt terms. And the 2-hour discharge duration systems have seen pretty consistent price declines since late 2014. Medium system prices declined about 9% year over year. And for power applications, we've seen less significant price declines. Here there's only been a 3% median price decline year over year. And one of the reasons for that is that we've seen fewer systems deployed for these shorter duration applications in the last year and fewer developers who are pursuing shorter duration projects. Historically, the PJM interconnect saw a massive amount of front-of-the-meter storage deployed for their Regulation D frequency regulation market. But as that market saturated, there were fewer and fewer opportunities for frequency regulation systems. And though, as I mentioned earlier, we have seen FR systems deployed in places like Texas, nevertheless, still front-of-the-meter developers are tending now to focus on projects that are at least 2 hours of duration, and in a lot of cases 4 hours or more of duration today. Behind-the-meter system prices have seen a pretty consistent downward slide as well, with a pretty fair drop-off year over year for non-residential systems, dropping from a median of $2,100 a kilowatt in Q1 2017 to about $1,825 a kilowatt in Q1 2018, and we're continuing to see we're continuing to expect a continuous decline of these systems as more folks are active in the market and scale up. Though it's important to note when it comes to non-residential systems that this is a pretty broad segment with everything from small mom and pop shops which might have a 30 kilowatt hour system all the way up to systems which are as large as certain front-of-the-meter systems getting into the 2 to even in some cases 5 megawatt hour range, which is one of the reasons for the fairly wide range you can see with the non-residential market. When it comes to residential, we have seen some recent price declines year over year, but they've been much more minute. This has been a market where it's still in the early adopter phase in a market that's already pretty small, and so there hasn't been as much activity to reduce prices compared to the other market segments that we track. So quickly, I'm going to kick off our market drivers section by discussing some recent policy developments through the end of 2017 into the beginning of 2018. One key theme I wanted to call out here with behind-the-meter policy developments is the trend of storage tax credit legislation. Now, storage tax credit legislation does not exist and has not passed in most cases. But nevertheless, we saw in the last few months a lot of this type of legislation introduced. Places like New Mexico, Hawaii, where it was introduced for the third time, and Virginia as well, with Maryland initiating their storage or opening up their storage tax credit program, which was previously passed earlier in 2017. And this shows that there is an interest at the state level in helping to promote energy storage, recognizing the value it can provide for behind-the-meter customers. It's an open question as to whether these policies will pass, and in a lot of cases it looks like they won't, but it's still good to see that legislators are entertaining energy storage and getting educated about it and thinking about ways to help push it forward at the state level. Something else important to note here as well is that we've seen a number of programs that are looking to fund energy storage demonstration and implementation projects to explore different business models that storage can provide. The Advancing the Commonwealth Energy Storage Program, or ACES program, in Massachusetts announced its award winners in late 2017, and those projects are starting to get underway to be deployed over the next couple of years. We've also seen demonstration projects announced in the state of New York. So really some exciting stuff going on with programs that are looking at how can we leverage these assets and these resources and understand the best business models to implement them so that we can see the that additional values that behind-the-meter storage can provide. And with that, I know that I have been talking quite a bit for the last 20 minutes, so I want to turn it over to my colleague Dan Finfoley, who's going to take us through some of the front-of-the-meter market developments as well as talk about the market outlook, where we see the U.S. market going through 2023. Dan, take it away.
Thank you so much, Brett. Quick reminder to our audience, the Q&A is, of course, open. Any questions that come up as you're listening, we would love to hear from you. We've left plenty of time at the end here to take your questions, so please do ask anything as it comes up, and we'll address as many as we can at the end of the presentation. So diving into my wheelhouse a little bit, the front-of-the-meter policy space. The first thing you'll notice about this map is that it is crowded. A lot of text on this page, and that is because there is quite simply a lot going on in the front-of-the-meter energy storage space, just as there was in the behind-the-meter energy storage space. The second thing you'll notice is that it's a pretty diverse group of states that we're looking at. This is focusing specifically on events in late Q4 and then into Q1 2018. And it's not really just the usual suspects, California, New York, Massachusetts, where we've seen a lot of energy storage activity ongoing in the past. There are markets such as Minnesota, Michigan, North Carolina, where we're seeing energy storage really get on the radar in a pretty big way. So this is a really exciting development from my end, seeing the way that we're getting a more diverse geographic footprint for the front-of-the-meter energy storage space and energy storage in general. Using this as sort of a starting point, I wanted to discuss a couple of key trends that are reflected here and were instrumental throughout 2017. IRPs, RFPs, and mandates. You know, a bunch of acronyms there for those who may not know. IRPs, integrated resource plans. RFPs, of course, requests for proposals, and then energy storage mandates as well. These are three trends that have been spreading from state to state. There's a bit of the energy storage FOMO going around, and everybody's looking to jump in on it. Looking at the IRPs, we did some great, my colleague Ravi did some great analysis on the IRP question for our last energy storage monitor. Since then, there's been even more news. Michigan's PSC has moved to require energy storage in integrated resource planning guidelines. In North Carolina, Duke released its integrated resource plan, showing the potential for 75 megawatts of energy storage in North Carolina. A lot of stuff going on, which is showing that either utilities or utility commissions are seeing the value of energy storage pretty significantly. This is a trend that we're going to see play out in 2018 as utilities either look to energy storage as a solution for a lot of their problems, seek to own it, or at the very least invest in it pretty significantly due to PSC or state-level mandates in that regard. That does bring us into the second category, mandates. We have, of course, the California mandate, which sort of started the ball rolling. That spread into a relatively smaller mandate in Oregon and then into the 200 megawatt hour mandate in Massachusetts. We're now looking at potential mandates, a mandate in New York, the size of that mandate still being discussed, and then a potential mandate in Arizona. In New York, Governor Cuomo proposed a 1.5 gigawatt energy storage target, which is a pretty big deal. This wasn't the announcement of the exact target. It's simply going to sort of inform the decision as they set the target moving forward. The more exciting part, in my view, was the $260 million in funding from the Green Bank and NYSERDA for deploying energy storage projects. This isn't just a suggestion on an energy storage mandate. This is more than $250 million in funding to developing energy storage. This is a really big deal in New York. In Arizona, the commission there proposed, or one commissioner, I should say, proposed perhaps an even bolder plan of 3 gigawatts of energy storage. This would also have included some other provisions, including the potential for clean peak standard as well. So really exciting stuff. On the RFP side, we saw a spate of RFPs across the country from Great River Energy up in Minnesota, looking at a solar-paired storage RFP. Nevada Energy launched some RFPs. Salt River Project in Arizona. Orange and Rockland is looking at a demonstration project to explore value streams there. And then we saw the Excel Colorado RFP results that were posted, median values for 2023 delivery for prices for projects for their renewables RFP. Those numbers made some big headlines, mostly because storage just looked so competitive, and specifically that solar plus storage and wind plus storage appeared to be increasingly viable and competitive. Standalone storage had a price tag of about $11.3 per kilowatt month, compared to gas at $4.8 per kilowatt month in the same RFP. May not seem too competitive, but that first number, the $11.3, could be inflated due to some very long duration systems in there. So it's definitely possible that 4-hour lithium-ion systems can be competitive in these procurements within the next 5 years moving forward. On the hybrid side, the adder necessary to include storage in the system was as low as $2.9 per megawatt hour for wind, and $6.5 per megawatt hour for solar for 2023. That's a really big deal because one of the last data points we had was the solar plus storage hybrid project in TEP that was announced with NextEra, where that sort of adder stepping up from solar into solar plus storage was closer to the $15 price point. Now, again, these are median numbers, 2023 values, and once again, we don't know the size of these storage systems, but it is a really good signpost that energy storage is getting to a very exciting place. I'll also hype one of our other forthcoming reports. If you were on the GTM webinar last week on natural gas peaker plants, you'll know that this is a topic that's increasingly going to be relevant over the next 5-10 years. The actual time frame may vary depending on how optimistic you are, but we're already seeing shots across the bow, as I like to put it, in California, as existing plants in PG&E and a planned unit in SCE both being re-examined with an eye towards installing energy storage. At the same time, PG&E is updating their mandate targets, announcing 165 megawatts of energy storage projects. I mean, and this all happened within the past couple of months. I haven't even talked about Massachusetts and their advancing Commonwealth energy storage systems, or New Hampshire's ruling on distribution utility zoning storage. There's simply so much going on that it's tough to even scratch the surface in a webinar. The one point that I will make before we jump on is talk about the FERC order, number 841, which is the culmination of a NOPR that was put out on energy storage participation in wholesale markets. And according to one energy storage system integrator that I spoke to, he chose to quote Joe Biden on this, that it was a big blank deal. I won't use the full quote. And it definitely is. This basically is mandating that all ISOs and RTOs need to reform their market rules to ensure that energy storage is eligible to participate and that it can provide all of the services for which it is technically capable of providing. On the surface, that seems like a really big deal, very exciting for energy storage to have access to billions of dollars in these markets, ancillary services, energy markets, potentially capacity markets. Digging a little deeper, it may be a cause to, tamp down on those expectations a little bit, simply because there are a lot of nuances to this. The first one, of course, is that ERCOT is not affected, won't be under the umbrella of this FERC order, or any FERC order for that matter. They may sort of watch what other markets are doing, and if they see value, follow up with it, but that's a big market right off the bat that won't be affected. Second, you already have a lot of proceedings that were underway in these markets. PJM and CAISO, as two markets, are already pretty compliant with the orders that were put out, so we don't expect many market rule changes there. MISO, New York ISO were already examining this pretty heavily. ISO New England is looking at it as well. So you may see some of the slower markets like SPP, MISO, ISO New England when it comes to integrating energy storage, defining eligibility. Those markets may get pulled ahead a little bit to catch up with the pack. But again, this is going to be a 2-year process. The order stipulates a 270-day period after the formal filing is put into place and to design the tariffs, and then another year to implement them. And that 270-day clock doesn't even start until the order is 90 days after the order is officially filed, which hasn't happened yet. So we're looking at the end of Q1 2019 before we start seeing these updated tariffs put out by ISOs. The process with which they're going to ensure compliance is going to vary by ISO. This isn't about creating a new game for energy storage. This is about evening the playing field for the games that already exist in these markets. And the mechanisms of doing so are going to vary pretty significantly. In the latest MISO Energy Storage Task Force meeting, there wasn't really any clarity on whether that task force is going to be handling the process of this Order 841 compliance. It could be that it happens outside of the stakeholder process. So this is going to be a long process moving forward for all of these different ISOs, ensuring they're compliant, ensuring that energy storage is eligible. And one last thought that I'll leave you with on that is the question, those two little words of technically capable. When you add those words into the discussion, things get a little bit hazier from my perspective. ISO New England, PJM have open-ended capacity requirements, for instance. Could you argue that energy storage as an energy-limited resource is not technically capable of providing capacity products in those markets because it's energy-limited and it can't operate indefinitely? I think that those ISOs could really make a case that energy storage could not participate in those markets. So keep your eye on that. It's going to be a very important to have stakeholders involved in this process moving forward at the ISO level, really sort of try to steer these discussions, so definitely lean into that if possible. All right. From there, I wanted to quickly touch on our coverage of the Section 201 solar tariff trade case. This map here is highlighting what markets are going to be affected by this at the front of the meter space. But I did want to sort of provide just a little bit of context for those who may not be familiar with the trade case. Obviously made a lot of news. The timeline essentially was that this Section 201 trade petition filed by Suniva and then joined by Solar World was filed in April and May of 2017. The U.S. ITC voted unanimously in September that serious injury was occurring due to imports of these solar cells and modules, and recommended some actions to the White House in November. The White House then issued a decision in January implementing an ad valorem tariff, which essentially means a percentage-based tariff, over 4 years, starting at 30% in year one and declining to 15% through February 2022. Adopted one of those proposed remedies and paired it with a cell quota of 2.5 gigawatts. The net result of this from the solar side of our GTM research team is that we're going to be seeing an increase in dollars per watt prices for modules for solar, starting at about 10 cents and then dropping down to about 4 cents by year 4. This is going to affect newly installed capacity pretty significantly and specifically on the front of the meter side for solar. Energy storage and solar are becoming increasingly intertwined, so it's very difficult to disentangle them in this regard. Anything that affects solar right now is probably going to affect storage at the same time. What we're looking at is here a map of sort of where we're seeing active solar plus storage projects, pipeline projects, any sort of historical activity, to see which of these markets is likely to be affected, is potentially going to be affected. A couple of the big ones, of course, would be California and Arizona, two very sunny areas, which is why a lot of conferences keep being held there. New build could be affected pretty significantly in the short term, especially with the tariff being a high percentage early on before dropping off. But overall, I'm still pretty bullish on the energy storage plus solar market, and I have to always check myself if it's bull or bear. I can never remember because they're both just large, potentially angry animals, so I always have to remember which one. So my point is I'm optimistic about this for a couple of reasons. The first one is that the economics of solar plus storage are already at a pretty exciting level in a lot of areas with good solar resource, such as Arizona. I think that the economics of this are going to be able to absorb the hit in the short term pretty well, especially as the ITC still takes place over the next couple of years. That specifically would be a factor in Arizona. In addition, there's already a lot of solar on the grid and not a lot of energy storage on the grid. If you're looking to solve these problems that increased solar penetration is creating, and of course I'm talking about the infamous duck curve in California, where net demand after solar drops down precipitously during the sunny hours and then spikes very high during the evening peak, requiring a lot of peaker assets that maybe wouldn't be operating much during the day. You know, that problem already exists, and it's actually accelerated faster than was modeled back in 2015. So there's still opportunity for energy storage to help solve these problems right now. And the third thing is that standalone storage is still just a really great opportunity. We think that standalone storage is going to remain the majority of the market moving forward, but even after absorbing this, the news that we'd seen on energy storage plus solar had me revise our forecast up over the past 5 years for solar plus storage, over the next 5 years for solar plus storage applications, simply because there's so much rumbling about new projects being announced, this idea of clean peak resources, PPAs for solar plus storage that are being structured in creative ways, that it's not going to be as big of an effect that it could have been. There are going to be some markets where I think there's going to be some slowdown, and there will be some depression or suppression of the storage market over the next 2 years or so. Minnesota was an emerging market that I was very excited about. it could stall the market there. It was really emerging as an exciting opportunity. A lot of interest in solar plus storage, but of course, simply due to its latitude, not a really great solar resource area as compared to, say, Arizona or West Texas. North Carolina as well had a bit of an emerging solar plus storage market where a municipal utility there was looking at it as almost a deferral asset, sending out 12 different solar plus storage projects across this distribution grid to provide a lot of services. And then Texas as well, its solar market was set to take off pretty heavily over the next couple of years. That could be slowed down as well. Other markets, Hawaii I think is going to continue apace. Massachusetts is going to be driven a lot by these incentive programs that are still ongoing. And then potentially in some markets the economics could simply still play out. I think it's also worth noting that this has a potential upside for energy storage, and I'll let Brett speak about this a little bit from the behind-the-meter side as well. If you are a developer looking to install a solar system and you're looking at energy storage, adding energy storage sort of allows you to diffuse the increased dollar per watt for your solar systems across a larger project while potentially providing more services. That could be a potential upside to the solar tariff situation for energy storage, even as the solar industry feels the impacts a little bit. Brett, I wanted to hand this over to you real quick to get your quick opinion on the behind-the-meter side for the 201 trade case.
Sure. Yeah. Thanks, Dan. And yeah, as Dan already mentioned, there's the intertwined nature of solar and storage. This is felt even more strongly on the behind-the-meter side, particularly for the residential market, where the majority of energy storage systems installed today are paired with solar. So any decline in the solar market is going to have effects on the storage market. Now, there will be some negative effects, but not as big as the negative effects for the solar market, and there are a few reasons for this. One is that we've still got a number of the market is still dominated by early adopters who are less price sensitive, likely would purchase a solar plus storage system even if the price increases slightly. But additionally, another piece to add, which kind of builds off something Dan said, is thinking about the additional value that we're seeing solar installers and developers think about how they can get storage as a value add to their solar projects, and looking at markets where it could actually be advantageous in some cases to do solar plus storage rather than solar only. So this is a big consideration, which makes the total quantity of some of the decline from Section 201 not hit the behind-the-meter storage market as heavily as it will hit the solar market. And it's also important to note that on that solar installer and developer piece, that the majority of folks that I've spoken to have anecdotally said that they expect their storage business to increase in the coming year, and that they expect a greater proportion of their solar to be paired with storage. And then on the flip side too, also even speaking with historically storage-focused developers, folks have been saying that they're moving to a greater proportion of solar plus storage versus storage only in their overall mix of business. So just a few things to consider there. Dan, I'll turn it back over to you.
Thank you, Brett. So now that we've talked about the drivers in myriads of detail, we have synthesized this, consulted our crystal balls, paid exorbitant sums to our psychics, and we have constructed our new energy storage 5-year outlook through 2023. So I wanted to run through that quickly and let you know what's going to happen. On a gigawatt scale, we're seeing U.S. energy storage annual deployments reaching 3.3 gigawatts by 2023. In addition, one thing that I'm especially excited about, and Brett, I assure you are too, is that behind-the-meter deployments, residential plus non-residential, are going to make up half of that annual market by 2022. This is an inflection point that is really exciting from a scaling of this market. And you saw that earlier in the quarterly deployments, as we had a really big quarter for residential and non-residential deployments. The annual market is going to cross the 1 gigawatt threshold in 2019. And overall, it's going to grow at a 15 times, the market will grow 15 times between 2017 and 2023. One of the drivers that we're seeing here is there were some projects in 2017 that were scheduled to come online at the end of 2017 that did get bumped into 2018. Brett, I believe you mentioned that as well. So that helped sort of the short-term outlook for 2017 while dropping the 2017 numbers a little bit as well. Looking at this from a market potential standpoint, we're looking at a 12 times increase in value between 2017 and 2023. That's a $3.8 billion market by 2023, and it will cross that $1 billion annual value mark in just 2019, so 2 years from now. This is a big market, scaling up quickly in a very exciting way. One of the points I made earlier is one that I wanted to leave you with regarding our forecast, and that is the increasing diversity that we're seeing. And I wanted to give you a quick peek behind some of the more granular data that we use to build out that forecast. This chart here is tracking the total pipeline for energy storage front-of-the-meter projects in the U.S. This is all available through the energy storage front-of-the-meter data hub that we offer. And it's a data point that we use to inform our forecast. A lot of these projects are interconnection queue data projects that are speculative or in very early stages of development and may or may not get installed. So what we've seen historically has been California's interconnection queue announced projects have been driving a very large percentage of that market. And that California interconnection queue report also includes a few very large projects in Arizona that you should take with a grain of salt. I wanted to include this just because that increasing geographic diversity is exciting, and it's going to happen market by market in ways that are going to be exciting to see emerge in real time. The one that I wanted to point you to here is Massachusetts. Massachusetts had a big spike in interconnection queue requests in Q4 2017. Some very large projects, solar paired, one project that was announced that was potentially going to be paired with an offshore wind farm. So Massachusetts really made a big splash popping into the scene. This is going to happen market by market over the next couple of years as these states build out mandates, build out legislative support mechanisms, and more importantly, as prices fall, as wholesale market eligibility persists and grows. So expect to see this chart become a little more multicolored with California not dominating it as much, and expect that to inform our forecast as well. For any more information, of course, the Energy Storage Monitor was just released yesterday, so we're quite timely on this one. The contents of the full report are here, including our full analysis on the Section 201 trade case impacts on the U.S. storage market, and deeper dives into all of the topics we talked about today, including market trends for front-of-the-meter and behind-the-meter space, our market overview, system price trends, vendor trends, etc. So with that, I would like to thank you all for your time. Any other interest or follow-up questions, we would love to hear from you. Our emails are here. And with that, I believe, Sonora, I'll hand it back over to you for our poll question really quick.
Great. Thank you so much, guys. Before we begin the question and answer portion of today's call, I would just like to let everyone know a little bit more about the Quarterly Energy Storage Monitor, which is the source of all the great information that you heard today. It's delivered quarterly, and it provides the industry's only comprehensive research on energy storage markets, deployments, policies, regulations, and financing in the U.S. And although all members can access the executive summary, access to the full report is available to ESA members on a subscription basis. So we just wanted to, do a quick refresh and reset to see who would like to receive that full report. So if you wouldn't mind taking this quick poll here to let us know if you'd like a member of the GTM research team to contact you with more information on how you can receive the full report, just go ahead and let us know. Just answer, if you'd like to receive it, just answer yes, and we will have someone get in touch with you. I'll just wait a couple seconds for people to answer the poll. And while we're waiting, I just want to remind everyone that you can submit questions in the chat box on the left side of your screen. Great. So, Brett, it looks like we've gotten some good responses so far, so I'll go ahead and throw it back over to you for the questions portion.
Great. Yeah, thanks, Sonora. We look forward to taking your questions. And please don't shy away from difficult questions. Today is actually Dan's birthday. Happy birthday, Dan. So the birthday boy would certainly like some challenging questions as a gift.
Yes, all I want for my birthday is some really hard-hitting questions from the ESA membership, that's for sure. Wouldn't be anywhere else I'd rather be than talking energy storage today, though, that's for sure.
All right, so let's dive in and see what we got here. First question, I know this is U.S. data only, but can you comment on global growth or U.S. as a percentage of global deployments? That's a good question. At this time, we don't have a view on total global deployments, though we are working to put out a GTM global storage outlook. Should be out, in the not too distant future, and we've been working to lay the groundwork and build out some of our global coverage. But yeah, at this time, can't comment on that one. Second question, which actually looks like two questions in a row at similar points on pricing trends. What is included? So these are all in system costs. So this is the battery system, BOS costs, installation, but this is without any land costs, without any special interconnection requirements. So on those two, let's see.
Yeah, and just a quick note on that, Brett, is as a side note, these are, as Brett mentioned, fully installed system costs, no special interconnection requirements. One interesting potential repercussion of FERC Order 841 is the wording is a bit ambiguous, but it may change the way that energy storage systems are reviewed for interconnection agreements. Right now, energy storage is sort of hit twice in this regard. They are modeled as a load asset and they're modeled as a generation asset in the worst case scenario. So if you have an energy storage system in Massachusetts, you're modeled as a load asset during the time of peak demand when it would be worse to be a load asset, even though under any sort of most conditions you would almost never charge your system during that time. In addition, say in California, you're modeled as an asset that will discharge energy during times of high solar penetration, et cetera. So energy storage is really dinged twice in this regard, and it can increase the cost of interconnection upgrades, et cetera, or slow down a project, increase the cost marginally for those sort of things. So there's potential that this FERC Order 841 may influence the way that those decisions, those studies are assigned or valued. So that could potentially be a little bit of an upside that I wanted to bring up quickly as I was thinking about it.
Yeah, great point. Thanks, Dan. All right, so next question. I think this is a good one for you, Dan. Do you see long-duration storage becoming increasingly necessary for cost-effective balancing in your forecast? If so, when do you see the business case for long-duration storage taking off?
Interesting. So this all comes down to what we're really defining as long duration. As you know, the market trend has, of course, been going from 30-minute ancillary service applications in PJM in 2013, 14, 15 to now closer to 4-hour duration systems over the past year or so for capacity applications in California. As the market expands, you're going to see those long duration systems become more important. Any sort of hedging mechanism for a capacity obligation in a newly opened wholesale capacity market, I think, will require some long-duration storage. We've also seen announcements for longer than 4-hour systems for either solar firming in Hawaii, renewable integration, and an 8-hour system proposed on Nantucket, of all places, for transmission deferral to that island. There's a couple of undersea cables. Laying a new one would be a real pain in the butt. But they need a little more generation during peak tourist season. So rather than lay an entirely new cable, build an energy storage system that can charge, say, at night and then discharge during the day when load is high and defer a really significant amount of investment. That is going to drive some longer duration storage systems moving forward. When you're talking about the 8, 10, 12 hours, 24 hours, however long you're really talking about, that is going to be a driver. But I think in the short term, things are going to stick more towards the 4-hour Goldilocks zone moving forward. That's the point that energy storage has been competing pretty effectively right now. A good analysis to look at, I again will plug Ravi Mangani's webinar on energy storage threatening peaker plants without spoiling the result of that. There is some analysis there that shows that you don't need to get too long duration in order to effectively compete with a peaker plant in some markets. So a system that can, a 10-hour system and an 8-hour system are both going to serve the function of a peaker plant that was modeled there. So I don't think we need to get too long duration, but as we're talking about some of these more advanced applications, larger markets, that long duration system question is going to become increasingly important. I know I've said the word duration about 30 times in the past 2 minutes, so I'll stop there and go to the next question.
Cool. So our next question is, we discussed the Section 201 trade case, but they're wondering about the steel tariff. That's a very good question. We actually have a few colleagues who are putting together a piece on that. Just as kind of a quick hit thought on that from my perspective is that, historically front-of-the-meter systems have been in these large steel containers, but recently more developers are looking at and implementing concrete containers. So, with the increasing steel prices, we could see, I see more of a push towards some of those concrete containers, and I could see the argument for, a faster adoption of concrete containers than previously thought, and also a greater proportion of concrete containers in the overall percentage makeup of containers. Dan, do you have any thoughts on this? Anything different or?
Yeah, obviously it can have some effect in some of those components as well, but one area that I would draw attention to is hybrid systems, solar plus storage, wind plus storage. It could affect those markets pretty significantly as well. I haven't checked recently, but last time I did, wind turbine towers and many components were made out of steel. I don't think they've switched to wood or platinum or anything in the short term. So that market could be significantly affected as well. Mountings, tracking systems for solar too. These are systems that are often installed with steel. Aluminum, I think, plays a role as well in some of these systems. This could affect the project economics that we were so excited about from, say, the Excel Colorado RFP bids. Are those numbers going to hold if the new build solar, new build wind is potentially a bit more expensive on those sides? These are very large systems with big capital costs. Increasing those putting a tariff on those, increasing the value of those could potentially have a big effect. Quantifying that, still very new, so very difficult to quantify that. But I know our colleagues at MAKE and our colleagues at GTM Research on the solar side are looking into that now. So hopefully we'll have some good answers on that in the near term.
Great. All right. Next question. Why is pricing in kilowatt and not in kilowatt hours? That's a good question. So we actually historically did report our numbers in kilowatt hours, and this quarter switched to kilowatts, but you could actually convert those numbers to kilowatt hours if you just use a conversion based on the discharge duration of the systems as shown in the charts. And to be clear, for the behind-the-meter systems, those assume a 2-hour discharge duration. Next question. GTM chart shows in kilowatt versus kilowatt hour. How do you correlate to kilowatt versus kilowatt hour? I'm guessing I'm not sure I fully understand this question, but I think what I'm trying to tease out is the question of how do we know what both the kilowatt and kilowatt hour ratings are of systems that we record in deployments. That's a good question. So we have a variety of data partners, electric utilities, program administrators, a variety of other installers, system vendors, system integrators, developers, and we collect data from them, and then we parse that data internally, make sure we're not doing things like double counting. We run it through some of our internal checks, and then based on that we report the data. And so when we're collecting this data, we ask for data both in megawatt and megawatt hour terms from those who are reporting data to us. And in some cases, we only get the megawatt value, in which case usually we'll apply a multiplier to the value that we're supplied based, again, on some of the anecdotal conversations we've had with that person, or if we know what model of storage system they're using. It's easy to convert based on the parameters of those storage systems. If it's, say, a 5 kilowatt, 8 kilowatt hour system, we would just multiply by 8 over 5 to get from the kilowatt to the kilowatt hour value, for example. Next question. Where in the country is storage in the money without incentives or mandates? Good question. So behind the meter residential storage is in the money. One example where it would be in the money is in Hawaii, but that's still a special case. There's no incentive and there's no mandate there, but there still is that zero export rule that I touched on earlier, which is why storage there can be, can have a positive value, because it makes more sense to have a good-sized solar system and storage rather than undersizing your solar system. In terms of, and then there are other places where it's in the money but are, more dependent on, things like incentives, as you said. I did some residential modeling recently and found, storage being in the money in places like SCE territory, SDG&E, PG&E territory, under, TOU rates under NEM 2.0. As well as under the SMART program in Massachusetts. But again, that is incentive dependent. Though SMART, you could argue, isn't really an incentive because it's a solar program, but there is a storage adder element of it, which adds extra value to a solar plus storage system. For non-residential, things are different, given that there is value that can be extracted from demand charge management, shaving those 15 or 30-minute peak periods to reduce C&I customers' electricity bills. There you're seeing places where there will be deployments that are not necessarily tied to incentives. Of course, California is still the leader because they can claim the SRIP incentive, but we do see C&I deployments going in other places. And in fact, our colleague Ravi Mangani did an extensive modeling effort back in 2016 looking at standalone C&I storage across the U.S. to see where it was in the money. And there were a few places that, were expected, California being one, New York being another, but then there were some that popped out as pretty interesting, like, say, Michigan, for instance, under, a specific DTE tariff. And so the big takeaway there is effectively anywhere where you see a demand charge of $15 a kilowatt month or higher, storage sees a healthy IRR as a standalone C&I proposition. Dan, do you want to comment on this from the front of the meter side in terms of where we're seeing storage in the money, songs, mandates, and incentives?
I would love to. And of course, I'm going to immediately cop out by saying it depends on the application, which I guess is probably not the answer that you want to hear, but absolutely true. A lot of the states where we're seeing a lot of deployments, of course, there is some sort of mandate or incentive involved, whether it's Massachusetts with the various incentive programs there, California with the mandate, or even Arizona with solar plus storage, which is, of course, incentivized by the investment tax credit. There are markets where energy storage is in the money from one perspective, but with merchant generation, it's like the weather in Boston. If you don't like it, wait a minute. We saw with PJM systems that were very well in the money with the Regulation D signal. That business opportunity evaporated to the tune of maybe 90% of the potential monthly revenue based on some analysis I did last year, based on signal changes, design changes to the market, dropping clearing prices, et cetera. So where storage is in the money now, such as places like the Texas frequency regulation market, where we saw a lot of deployments this past year, can really change moving forward. One area where I would want to draw attention to where it's potentially pretty cost-effective right now is in the region of transmission and distribution deferral. Oftentimes it's hard to sort of establish whether a project is, how much of its value is in its the fact that it's a pilot program or the utilities learning about storage, et cetera. With deferral applications, you straight up know that the system is more effective, cost-effective than a distribution or transmission solution, because that's the definition of a deferral application. You're deferring investment by installing a system that's cheaper. And there are cases where that's popping up more and more. AES, I guess Fluence now, I have to remember to start saying Fluence more, installed some systems in Arizona that met that need for a remote town, obviously Nantucket as well. You're going to see those sort of markets pop up as places where storage can compete right now with costly transmission distribution upgrades. In terms of competing with conventional generation, peaker plants, other assets, those are things that we're looking at constantly. So I would say watch the space. Definitely check out the peaker plant webinar. I don't think I've plugged that enough, but it was really cool. And yeah, keep reading Green Tech Media and follow the Energy Storage Monitor for more info. All right, I've got one.
All right, so I think we have time for one more question, and then need to wrap it up. And this question is for you, Dan. So I guess this is the final birthday present for today. How much front-of-the-meter storage will be driven by hybrid systems in percent terms through 2023? Do you think existing business models in regulated states, such as PURPA, that have driven solar and wind deployments in regulated states will lend itself well to hybrid systems? And do you consider such policy innovations when forecasting? Good question.
Oh, that's a great question. Just the kind of present I wanted. So I have done some analysis on this, looking forward, sort of going piece by piece a little bit. Solar, I think, is obviously the most exciting opportunity. Based on the forecasting exercise that we did over the past quarter, I anticipate that within 5 years, 1 out of every 3 new megawatts of energy storage that is installed will be paired with a solar asset. From there, you have a lot of other hybrid technologies. Wind energy is not really cost-effective right now, simply because it's not as clear a business case as solar, where you have a much more predictable the word I'm looking for, profile for energy as opposed to wind. Investment tax credit for solar versus the production tax credit for wind being more effective. Within the next 5 years, I don't see that market developing at scale. Maybe beyond that, if wholesale markets evolve and change and you're looking at more curtailments, et cetera. Then you have other potential hybrid systems. Natural gas is one that people have looked at before. Looked pretty exciting, but as energy storage sort of has proven it can do these things standalone, it's not as clear, more of a competitor than a partner, it looks like. So yeah, I would say that, of course, definitely there is that is worked into our model as well. In terms of the regulations, policies that would drive that in the way that PURPA has, it's tough to say if standing alone it can do as well as wind solar has done by itself. If energy storage plus wind plus solar can do the same, because it's a much more complicated question. These two technologies or more technologies now have their fates sort of tied together. What happens to one happens to the other in a big way, and incentives are going away for those. Are they going to be replaced by incentives for energy storage? So far, it looks like it. It looks like we're moving towards that, and increasingly products that would look at the issues caused by solar, or not issues, look at some of the challenges solar faces and apply energy storage as a potential solution are getting real looks from utilities, from regulators, et cetera. So I would say that hybrid systems are going to play a very large role, I'd say at least a third of the market by 2023, and expect it to only grow from there.
Okay, thank you so much, guys. What a great hour packed with so much great information. I just want to thank everyone for sticking on a couple minutes extra. Just a few quick reminders before we wrap up. I just wanted to invite everyone to join a very important webinar on March 14th about the federal tax credits for storage and renewals. It's regarding the recently released IRS private letter, and our speakers will be from the Deloitte tax office here, Brian Americus and Gary Hasimovich. So I hope you can join that. Also wanted to invite everyone who enjoyed hearing Dan and Brett speak today. They will also be speaking at our annual conference in April in Boston. So I just would like to invite everyone to attend that conference, and you can find more information and register at www.energystorage.org/readyforbusiness. And again, we're a little over time, but I just want to thank Brett and Dan and the GTM folks for all the great information and for speaking today and for the insightful presentation. So thank you, guys. I hope everyone has a great day. And if you have any other questions about upcoming events or webinars, please feel free to contact me at s.monks@energystorage.org. So thank you very much, Brett and Dan, and I hope you guys have a great day.
Thanks, Sonora. This was great.
Thank you, Sonora. Thank you, everybody, for coming. Thanks for the questions.
Okay, thanks all. Bye.
Bye.